lot of people need to know about offerings now, and just going into that, I think just going into the basic of like what an offering is and what it means for the company.
Yeah. I get this question at least 50 times a day. I haven't counted, but it's incredible. So you have two different filings. You have an S3 and an S1. Okay? The S1 is usually the filing that right before an IPO. And then if a company is doing an offering at that time, then that is the filing that they will file. And then you have an S3, which is a shelf offering. And what that means is that they can basically, like it says, put it on the shelf, not think about it, and then they can pull it out whenever they want, and they can drop it whenever they want.
How long are shelf offerings usually good
3 years. They're good for 3 years, and then they can file another one, and it's no big deal. But I think the biggest thing that we also have to talk about is the difference between dilutive and non-dilutive offerings. So we talked about it last week about dilution, and so it adds to the total number of stock shares available to the public, which is huge. Then you have non-dilutive offerings, and that doesn't add to the number of shares available. And it can be selling stock held by major shareholders. It can be shares are only changing hands, so like more of like a swap. And that's when you have to understand. I think some of the best plays are when some of these filings come out, and then people actually read them, and they realize that shares were just changing hands. It doesn't change the flow. And the other thing that is huge to understand is, why is the company doing this?
Is it like more of a financial issue?
Exactly.
I mean, there's so many reasons.
Exactly.
Right?
You got to know what the burn rate is. So the burn rate quarterly is how much cash do they go through in a quarter. So if they go through 30 million in a quarter, and as of March 31st, they had 22 million, guess what they're going to have to do? An offering. Because there's no way, chances are most of these companies aren't going to reduce their expenses by that much, that extreme. So it's really, and you got to look at the balance sheet, you got to know the burn rate, you got to know how much cash they have, and then that's when you really have to utilize the investor relations and ask them, how much cash do you have? Like you even if they say, look back in the offering, you just need to hammer them. You need to hammer them, because at the end of the day, the only person that is, and I say this all the time about Roth IRAs, offerings, everything, the only person that's going to look out for your money is you.